Welcome to Iron Financial. We're here to help you forge a stronger portfolio and cut right through the market weakness. I'm your lead analyst. Listen, every so often, a company comes across our desk with numbers so powerful, so explosive, they demand a closer look. Today, that company is AGI Incorporated, ticker AGBK. They are trying to build a financial skyscraper down in Brazil, one that scrapes the clouds. Our job, our only job today, is to perform a full structural analysis and figure out if that foundation is built on solid bedrock or if it's all just smoke, mirrors, and sand. Let's get to it.
So here's how we're going to break this down. We're running a full-scale stress test. First, we'll fire up the Brazilian growth engine to see the raw, top-line power this thing has. Then we'll move on to forging the framework, where we'll inspect the operational guts of the company. After that, I'm bringing in our market skeptic. He's going to be looking for any cracks in the foundation. From there, we'll try to figure out why the market seems to be giving this company the cold shoulder. Then, we'll look at management's secret weapon, what they're calling the AI reinforcement. And finally, we will put it all together and deliver the final verdict. Let's get to work.
All right, let's get the lay of the land. AGI Inc., AGB, is a Brazilian fintech that just recently IPO'd here in the United States. Now, what makes them interesting is their model. It's a hybrid. They've got the slick digital banking app you'd expect, but they've paired it with over 1,000 physical locations they call smart hubs. And their target market? It's huge. They're going after the 100 million Brazilians. Think Social Security beneficiaries, public sector employees, the people that traditional banks have frankly just ignored for decades. And judging by the numbers we're about to see, they are not just tapping into this market, they are hitting it with the force of a tidal wave. And this, right here, this is what I'm talking about. This is the sheer velocity of the operation. This isn't your garden variety 5 or 10% annual growth. No, we are talking about a 73% explosion in their customer base and a 47% surge in revenue in 1 year. These are the kinds of numbers that get a stock on every single trader's watch list overnight. This is the core of the bull case, and right now, that engine is absolutely roaring.
Let's anchor those percentages with some cold, hard numbers. By the close of 2025, AGBK had 6.7 million active clients on their books. Now, to put that in perspective, they were at 3.9 million just 12 months earlier. That's a 73% jump. This isn't just steady growth, this is a land grab. It's an all-out acquisition blitz, and it tells you, loud and clear, that their hybrid model, digital plus physical, is hitting a nerve in the Brazilian market. They found a massive, underserved population, and they are moving in with stunning efficiency.
And here's the other side of that coin. It's not just about getting customers in the door, it's about getting them to open their wallets. The company's revenue grew by just under 47%, hitting an incredible Rs 10.7 billion, which translates to about $1.9 billion US dollars. Now, the key thing to understand here is that this isn't some one-time sugar high. This represents a compound annual growth rate of 48%, stretching back to 2022. So what we're seeing is sustained multi-year acceleration. They're adding clients and monetizing them at a world-class rate.
And here it is, the number that ties it all together. Because look, top-line growth is exciting, but profitability? That's what separates the real heavyweights from the lightweights. AGBK didn't just grow. They posted over 1 billion Brazilian reais in net income for 2025. That's a 32% increase from the year before. So let's just recap the opening argument for the bulls. You've got massive customer acquisition, you've got revenues that are shooting through the roof, and you've got powerful growing profits. On paper, this company looks like an absolute fortress.
Okay, so the outside of the building looks fantastic. The growth numbers are painting a picture of a skyscraper reaching for the heavens. But any serious investor knows you don't judge a building by its facade. You have to go inside and inspect the framework, check the load-bearing walls. Headline numbers are for amateurs. And to help me do just that, I'm bringing in our market skeptic. Skeptic, let's start by digging into the operational strength here.
So this table really lays out the core structure perfectly. You can see the revenue and net income growth we were just talking about. Those are the steel pillars holding this thing up. The client growth shows you the expanding footprint of the foundation. But Skeptic, I really want you to focus on that last line, return on equity. Even at 35.8%, that is an incredibly efficient number. It tells me they're using shareholder capital like rocket fuel.
It's a high number, analyst. I will absolutely give you that. But my eyes go to the only number on that entire table with a minus sign next to it. It dropped almost 9 full percentage points in 1 year, down from 44.4%. Now, that's not a reason to panic, but it's like smelling a bit of smoke in a brand new building. Is this the price of that blitz you were just praising? Are they becoming less efficient as they scale up?
I'd argue it's just the furnace cooling slightly after being white hot. You can't grow this fast without massive investment, and that can put some temporary pressure on ROE. It's a data point for sure, but I think it's dwarfed by their absolute dominance in the market.
And this, right here, is what I mean by dominance. This chart shows AGBK's market share in a critical segment for them, INSS payroll credit. This is lending to Brazil's Social Security recipients. Just look at the progression. In 2021, they were basically a nobody, with just 2% of the market. Fast forward to 2025, and they've captured almost 9%. This isn't just growth skeptic. This is conquest. They are systematically taking territory from the old, slow-moving banks and building a massive competitive moat. This is how you build an empire.
An empire built on what, analyst? Conquest is never cheap. When I see a company take that much market share that quickly, my first question is always, what did you have to sacrifice to get it? Did you lower your lending standards? Did you take on riskier clients? Let's hold off on the coronation for now.
All right, analyst, you've made your case. And I'll admit, it's a powerful one. The growth is staggering, the numbers are impressive. But my job isn't to admire the architecture. My job is to take a sledgehammer to the walls and see what's behind them. So while you were up on the penthouse floor enjoying the view, I was down in the basement with a flashlight. It's time we talk about the cracks in this foundation.
And at the end of the day, that is the only question that matters, isn't it? Anyone can throw up a building quickly. The real test is what happens when the wind starts to blow. This kind of explosive growth is incredibly seductive, but it often serves as a beautiful facade to hide some really ugly fundamental flaws. So we have to ask, is this a marvel of disciplined engineering, or is it just a reckless, headlong rush for the sky? Let's dig in.
This slide right here frames the entire debate we're having today. It's the essential conflict at the heart of AGBK. You've got the bull case, which the analysts laid out so well, this undeniable massive growth engine. And then you have the bear case, whispering in your other ear, pointing to some pretty scary warning signs that are starting to flash on the dashboard. It's the irresistible force of their growth smashing up against the immovable object of rising risk. Let's see which one gives.
So here's the very first stress fracture I found. Non-performing loans, or NPLs. These are loans that are over 90 days past due, the ones you start to get really nervous about. And they're ticking up. They went from 3.0% in 2024 to 3.7% in 2025. Now, management will tell you this is still at comfortable levels. Of course they will. Management always says that, right up until the moment it's not comfortable anymore. So, analyst, I have to ask, is this the cost of that 73% customer growth you love so much? You don't get that many new customers that fast without lowering the velvet rope. The question is, how many risky customers did they let in?
And this chart shows that it's not an accident. This is a deliberate, calculated shift in strategy. We're looking inside their loan portfolio now. Back in 2022, unsecured loans, the riskier kind, not backed by any collateral, made up 75% of their book. By 2025, that has jumped to 86%. This means they are actively choosing to move away from safer asset-backed lending and dive headfirst into the deep end of unsecured debt. Why? Because the margins are higher, but so is the risk of getting wiped out. They are consciously cranking up the risk dial to keep that growth engine humming.
And hey, don't just take it from me. This is a direct quote from a third-party analysis by Guru Focus, a platform that's famous for its no-nonsense, deep value screening. They rate AGBK's financial strength as poor, and their number one reason? High debt levels. This is a five-alarm fire, folks. The income statement is telling this beautiful story of growth and profitability. But the balance sheet? The balance sheet is telling a much darker story about leverage and financial fragility. This isn't a hairline crack, analyst. This is a major fault line running right through the foundation.
So what we have here is a tale of two companies. You've got the company described in the annual report, with its incredible growth and profits. And then you have the company with rising bad loans and a poor financial strength rating. So which one is real? Well, let's ask the ultimate judge, the market itself. Because right now, it looks like Wall Street is siding with me on this one. There's a massive disconnect between the story management is telling and how the stock is actually behaving. Remember this number? The analyst was very excited about it earlier. Almost 47% revenue growth. A spectacular number. The kind of number that should have investors beating down the doors to get a piece of the action. It's the centerpiece of their whole growth story.
But then you have this number, an 8.3% drop in the stock price since its US IPO. So how on earth is that possible? How can a company report nearly 50% growth and have its stock go down?
It's because the market is telling you something. It's saying, we see your growth, we see the shiny numbers, but we also see the risk underneath. Wall Street isn't buying the hype, analyst. They see the same cracks that I do.
And this is precisely why. The valuation is priced for utter perfection. A price-to-earnings ratio of almost 46, a price-to-sales over 7. What that means is that there is zero room for error. Any hiccup, any slowdown, any increase in those bad loans, and this stock could get crushed. The market is signaling loud and clear that at this price, the potential reward simply does not justify the risks we just talked about. It's like you're being asked to pay the price for a fully finished, sold-out skyscraper, but you're buying it while the concrete and the foundation might still be wet.
All right, Skeptic, you've landed some solid punches. The rising NPLs, the strategic shift toward riskier loans, that guru focus warning, and the market's cold shoulder. I won't deny it, those are all serious points. But here's the thing, management isn't blind. They can feel the same tremors you can, and they have a plan. They are bringing in heavy-duty reinforcements to shore up the entire structure. And their weapon of choice is one of the most powerful technologies on the planet right now, artificial intelligence.
What's crucial to understand here is that this isn't just a marketing gimmick. This isn't them just slapping the AI buzzword on a press release. They are embedding this technology deep into the core of their operations to address the very risks you brought up. They're using AI for smarter credit underwriting. That's their direct answer to your NPL concerns, but it doesn't stop there. They're using it to slash customer service costs, to cut fraud review times by a staggering 90%, and to make their collections and even their legal departments radically more efficient.
I see the list, analyst, and it's impressive, but is this a real fix or is it just a high-tech coat of paint on a crumbling wall? AI is powerful, but it can't magically turn a bad loan into a good one. It might help you collect the debt more efficiently after the fact, but is this actual risk prevention or is it just a better mop for cleaning up the spills?
It's both. Smarter underwriting is the prevention. More efficient collections is the better mop. To run a world-class lending operation at this scale, you need both. This is their strategy to manage the risk that comes with hypergrowth, making the entire building stronger and smarter.
And this isn't some mid-level manager's pet project. This commitment is coming directly from the top. That's a direct quote from their CEO, Marciano Testa, on their last earnings call. This is a board-level, sweet mandate to completely re-engineer the company around artificial intelligence. The bull case here, Skeptic, is that this aggressive push into AI will allow them to do what few companies can: maintain that explosive growth while simultaneously building a more sophisticated, more resilient, and ultimately stronger risk management framework.
So, there you have it. The lines are drawn. On one side, you have a growth engine that is firing on all cylinders, now being reinforced with a serious AI strategy.
And on the other side, you've got visible stress fractures in the balance sheet and a market that is clearly voting no confidence.
It's time to weigh all the evidence we presented and deliver the iron financial verdict. Is AGBK a generational opportunity, or is it a cleverly disguised trap? Okay, let's break it down one last time. The bull case, the opportunity, is all about the sheer overwhelming force of their growth. You cannot ignore the explosive customer and revenue numbers. You can't ignore a 35.8% return on equity or their dominant market share gains. And when you layer their aggressive AI integration on top of all that, it really does start to look like a rocket ship. But the bear case, the trap, is focused entirely on the cracks in that rocket ship. You have the rising non-performing loans. You have the high debt that led to that poor financial strength rating. You have the company's own strategic decision to move into riskier loans. And you have a market that is looking at the premium valuation and saying, no, thanks. It's just too risky for the price.
So in the end, it all boils down to this one critical question. AGBK is building a magnificent skyscraper. The growth is real. The ambition is clear. But is the foundation they poured strong enough to support the weight of what they're building on top of it? And can their new AI reinforcements patch those cracks before the next economic storm hits? The bull will tell you this is a marvel of modern financial engineering, a glimpse of the future. The bear will tell you it's a house of cards in a hurricane. You've seen the blueprint. The final call is yours. Always do your own research. This has been Iron Financial, helping you forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.